Your $400,000 mortgage is actually going to cost you over $900,000. And the way that number sneaks up on you is something most people never see coming. In the next few minutes, we're going to open up a real mortgage at today's average rate and follow every single dollar of your payment. You'll see exactly where your money goes in month one, why your balance barely moves for years, and the moment, down to the month, when your loan finally starts working for you instead of against you. Stay until the end, because there's a simple move that cuts more than $100,000 off this loan, and it costs less per day than a cup of coffee. Here's the setup. A $400,000 loan, 30 years, 6.43%. The national average rate this month. That works out to a monthly payment of about $2,510. Principal and interest every month for 360 months. Now here's the question almost nobody asks. When you send that first payment, where does the money actually go? Most people assume it's roughly half and half. Half pays down the loan, half goes to the bank. That guess isn't just wrong. It's not even close. Out of your first $2,510 payment, $2,143 is pure interest. Only $367 touches your actual loan. That's 85% of your payment going to the bank and 15% going to you. And that's not a fee. It's not a penalty. It's not fine print. It's just how the math of your loan works. And it keeps working that way for a very long time. Add up your entire first year. You'll send in just over $30,000 in payments. Your loan balance drops by $4,531, $30,000 out of your pocket, $4,500 off your debt. The other $25,588 gone to interest. And if year one feels bad, wait until you see year 5. After 5 full years, 60 payments, more than $150,000 sent to your lender, your $400,000 balance has fallen to about $374,000. 5 years of payments, $26,000 of progress. That's why your mortgage feels like it never shrinks, because for the first several years, it barely does. So what's actually going on here? Why is the loan built like this? It comes down to one word: amortization. And once you understand it, you'll never look at a loan statement the same way again. Here's the simple version. Every month, the bank charges interest on whatever you still owe. Not on the original loan, on the current balance. Early on, your balance is huge, so the interest charge is huge. Your payment covers that charge first, and only the leftover crumbs go toward the loan itself. 6.43% of $400,000 is about $25,700 a year. Divide by 12, and there's your $2,143 interest bill in month 1. Your payment never changes, but every dollar of principal you clear makes next month's interest charge a tiny bit smaller, which frees up a tiny bit more for principal. It's a snowball. The problem is that for the first decade, it's rolling in the bank's favor, which brings us to the number that shocks almost everyone, the crossover point. That's the month when your payment finally puts more toward your loan than toward interest, more to you than to the bank. On this loan, when do you think that happens? Year 5, year 10, month 232. That's year 19. Read that again. On a standard 30-year mortgage at today's average rate, you make payments for over 19 years before the majority of a single payment goes to you. By that point, you've already paid the bank more in interest than most people will save for retirement. And if you ride the loan all the way to the end, here's the final bill: $400,000 borrowed, $503,559 in interest. Total cost, $903,559. The interest costs more than the house, and there's a trap hiding inside this schedule that catches millions of homeowners refinancing. Picture yourself 7 years in. You've paid the bank $172,000 in interest, and you've finally clawed your balance down to about $361,000. By now, 77% of your payment still goes to interest, but the snowball is finally slowly turning your way. Then rates dip, and a lender offers you a shiny new 30-year loan. Lower rate, lower payment. Sounds like a win, but here's what actually happens. Your new loan starts over at month 1 of a brand new front-loaded schedule. All the ground you gained toward that crossover point, erased, the clock resets to 0, and the bank goes back to collecting its interest first. That's why some homeowners refinance 2 or 3 times and find themselves 20 years in, still owing almost what they started with. They never escaped the front of the schedule. They kept re-entering it. A refinance can still make sense, but only if the rate drop is big enough to beat the reset. Most people never run that math. The lender is not going to run it for them. Now, here's the part your lender doesn't advertise. This entire system has a back door, and it's shockingly cheap to walk through. Remember how interest is charged on your current balance? That's the bank's advantage early on, but it works both ways. Every extra dollar you put toward principal today stops being charged interest every month for the rest of the loan. $1 today saves you that 6.43%, compounding in reverse for decades. So let's test it with a number almost any homeowner can find. $200 a month extra, sent straight to principal. That small move pays the loan off 5.5 years early and saves $109,921 in interest. $200 a month, about $6.50 a day, in exchange for almost $110,000 and 5.5 years of your life back. Don't have an extra $200 a month? There's an even older trick. Make one extra payment per year. Many people use their tax refund. Same story. The loan ends 5.8 years early, and you keep $113,680 that was headed to the bank. And here's the detail that makes all of this urgent instead of just interesting. The math is front-loaded, which means the escape hatch is front-loaded too. An extra principal payment in year 2 saves you multiples of what the same payment saves in year 20. The earlier the dollar, the harder it works. So the real reason your mortgage never seems to shrink isn't bad luck, and it isn't a scam. It's a payment schedule deliberately built so the bank collects its interest first, and the design quietly counts on you never interrupting it. The homeowners who get out early aren't the ones who earn the most. They're the ones who saw the schedule and refused to follow it. Now you've seen it too.